information has been incredible.
I know. You know, my granny always said that gold is the way to go, but I'm sure that's not a stock, eh?
Well, the JSE actually does trade Cobie Legrange.
Really?
I'd actually be quite interested to find out what other securities they do trade at the JSE. Maybe we should go find out, but I think first, let's stay. I think there's an amazing session happening right now with Clem Sunter.
And Cobie Legrange.
Fantastic. I think that's... You guys all ready? Please welcome. Thank you very much.
Good morning, everybody. What a pleasure to be here.
Ladies and gentlemen, we are now starting the release of the main today.
Oh gosh, we're about to start here. True, but yes, I can see still people rolling in. What we want to do today, Cobie and I, is to go through a method for looking at different scenarios for the global economy, and then obviously showing how you apply it to investing your money in the stock market. I talk endlessly about foxes. In fact, you'll find just out there 3 books that I've written with a young woman called Chantal Ilbury, and it's called the Fox Trilogy, because I've been trying to get across to people over the last 10 years that you cannot predict the future. And if anything showed that, it was the financial crash in 2008. Which really came out of the blue for most people. And therefore, what you have to do is look at different possibilities for the world economy, which are scenarios. You have to look at the flags, which would indicate that you're moving into those scenarios. And then you have to attach probabilities to the different scenarios based on whether the flags are up or whether the flags are down. Let me give you an example of flags. In September 1988, when I was the head of the Anglo scenario team, we had a session in London, and the person who opened the conference was the best futurist in the world, a guy called Pierre Wack. He was a Frenchman, and he headed the process at Royal Dutch Shell. And in September 1988, he said the flags have gone up on Japan. And we all thought of Japan in 1988 like we think about China now. It is an unstoppable economic growth country. It had grown in money terms at 7 to 8% per annum, in real terms at 3 to 4% per annum. It had had this fantastic run in the 70s and 80s. So we said to Pierre, what are your flags? Particularly as he had a Japanese wife. So we felt we could get some inside information. He said the first flag is declining golf club membership in Tokyo. He said they're golf fanatics and they're resigning in huge numbers, which means something is happening to their disposable income, which isn't being captured by the media. And he said that combined with astronomical property values in Japan at the time. I mean, the Nikkei index, as Cobie will show you, was at an all-time high. And that combined with property values and share prices means that there's going to be a crash next year, and that will mean the economy will go into a dive. Now, the only thing that was wrong was his timing. It didn't happen in 1989, it actually happened in 1990. But as he said himself, as the great futurist, it's much better to be vaguely right than precisely wrong. And that was his first flag. But the second flag was even more prophetic. He says when they've had the crash, they're never going to recover. They're not going to have a V, they're not going to have a U, they're going to have an L, an endless L. Because he said his second flag is the demographics of Japan. It's an aging society. There's about to be a geriatric boom. If you sell walking sticks and hearing aids, good for business in Japan. But if you sell most other products, not so good. And he was absolutely right. Japan has gone nowhere for the last 23 years. It's had a very low growth economy. They're on QE 23. Quantitative easing 23. They've even had negative interest rates where you pay to have your money on deposit at the bank. But it hasn't stimulated the economy. So that's what aging demographics can do to an economy. And it's a flag, and I will talk about it a bit later on. The second example was in late 2006. I've been working, particularly in terms of writing these books on foxes, with a young woman called Chantal Ilbury, and we decided the biggest flag at the time for a recession was American property values, because we figured that if the major asset of most US consumers, his or her house, declined in value, then they'd stop spending. And since consumer spending is 2/3 of the American economy, that would then trigger a dive in America, which would then be transmitted to the rest of the world. And look, in retrospect, we were wrong, because what actually triggered the dive was subprime mortgages, something that we'd never heard about. But the flag we used was the prices of properties in most cities. It's called the Case-Shiller Index. And it topped out in the last quarter of 2006. We didn't say the flag's up because it just topped out after 20 years of growth. But then it declined. And after 2 months of declining, we thought, well, should we raise the flag? It went on till June 2007, and we gave a 50% probability to a recession scenario, even though the markets, the stock markets, were still rising. And we were saying to all our clients, be careful, because we're now giving a 50% probability to that scenario. Now notice how we work. We don't change forecasts. We run 2 scenarios. We called them hard times and long boom. And we changed the probability of the scenario as the flag went up on declining property prices in America. And certainly, in retrospect, a lot of those clients have thanked us because they took a more conservative view on the world because of the fact that we'd given them these flags and these scenarios. So what are we saying today about the global economy? Well, the first scenario we offer people, we call hard times. It's a flat world for the next 10, maybe even 15 years. It's actually the exact opposite of the world that we've had from 1982 to 2007. We had 25 years of growth, and it was a wonderful period to be an investor in the stock exchange because you couldn't help but make money. Now, we have flat markets. In fact, I've just been doing some work in London where one of the Providence funds said it's a race between poverty and death. and yes, that's what hard times is about. It's about a flat period which could last as long as the period we had of economic growth. And the reason we think it's a credible scenario is that the largest economy in the world has in fact worse demographics than Japan had in 1988. And it's not America. America is a $15.5 trillion economy. The largest economy in the world is Europe. It's an $18 trillion economy. And the demographics of Europe are terrible. If you put a roof over an English village, it's an old age home. But remarkably, Italy has had a declining population for the last 8 years. Incredible for a Roman Catholic country, but there you go. Declining population. It's the 3rd slowest growing economy in the world. Only Haiti and Zimbabwe have grown slower than Italy. And yeah, you cannot have growth when your population is declining. America is a bit better because of immigration. Their 35 to 45 age group is still growing. So we think that if America flatlines, it will flatline at a higher rate of economic growth, maybe 2 to 3% than Europe, which will be sub 1%. In that scenario, you can still make money, but you've got to choose companies that offer one of 2 things. Value for money at a particular price. In other words, the brand is so strong and the storyline is so strong that you are prepared to buy that product, even if it costs quite a lot. Apple is a case in point. People will buy the iPhone because it's seen as a status symbol. Or you've got to offer the cheaper alternative. And the best example in South Africa is Mr. Price. I had to do a strategy session for them the other day, And I remember one of the managers saying there's no such thing as a high net worth housewife left in South Africa. So they all come to Mr. Price with their egg goods bags and fill up. And yes, they've done extremely well out of the recession. So obviously in that environment, you have to invest in companies that offer value for money, or they offer the cheaper alternative. The alternative mainframe scenario we offer, we call ultraviolet. It's a two-speed world where the old world economies, like Japan, Europe, and America, grow very slowly. They're in this flat environment, but the new world economies, China, India, Africa, and South America, have a V-like recovery and grow at least 3 times faster than the old world economies. And in that scenario, it is obviously a good thing to invest in companies that are either in those emerging economies or multinational companies that sell their products into those emerging economies. So it's those companies that chase the V in Africa or chase the V in South America, which are the ones that you should invest in that second scenario. Our principal flag between whether we're in hard times for everybody or we're in the two-speed, ultraviolet, divided world is China. If China continues to grow at 8 to 10% per annum, we're in the two-speed world, because all the countries supplying China will grow fast too. But if China has the kind of experience that Japan had in the late 80s, then it's hard times for everybody. And we've gone more negative on China in the last 6 months for 2 reasons. Number one, 38% of China's GDP is exported to the rest of the world, and a lot of that exports go to Europe. And exporting into a flat Europe is not good for China's growth prospects. But secondly, there's a lot of unoccupied property in China. Not just apartments, whole suburbs of cities of 10 to 15 million people are empty. The municipalities have borrowed the money, they've built the suburb, and there's nobody moving in. I visited one in a place called Inner Mongolia, a place called Shifeng, where the only living object in the entire suburb was a Land Rover agency. So yes, we're more negative on China. So we give a 40% probability to hard times for everybody, a 30% probability to this divided ultraviolet world. And yeah, you watch the flag. You know, we watch everything on China to see whether we should be upping the probability on the ultraviolet scenario. It's like 2 horses. You just go on watching them, watching the flags, seeing which one is ahead of which one. But if you're a good futurist, you can't just look at the 2 favorites in the front. You've got to look at the outsiders. And we have 2 outside scenarios. A very positive one and an incredibly negative one. The positive one is where we're all wrong and Ben Bernanke is right. And his cheap money policy leads to a recovery in America next year. That drags the whole world economy up with it. And we call that scenario new balls, please. If you've watched Wimbledon, it's an expression that is used a lot. And what we're saying is that when the recovery comes, the game is going to change. And those companies that recognize the change in the game and have new balls are the ones that are going to do well. Because there are going to be 2 very important changes when the world recovers. Firstly, the East will be the economic equivalent to the West, which is huge since the West has dominated the global economy for centuries. In fact, the last time China was #1 in the world was around 1700. So in a funny way, we revert back to 1700. The second thing is even more important, is with 7 billion people on this planet, we're now moving into a situation where resources are becoming very scarce. I mean, just one statistic, if China ever reaches American lifestyle, you need 4 planets. Or we haven't got 4 planets. One other statistic, if China ever has the number of cars that America has, and the sort of big fuel gas guzzlers that America has, then the entire oil production of the world would go to China. So it shows. that resources are going to become scarce in a recovery scenario, and therefore the obvious choice of investment are those companies that specialize in fuel efficiency, energy efficiency chains, and of course new technologies such as solar technology and and wind power and all those things. We asked an energy consultancy in London, what could the oil price go to in a full recovery scenario? Without blinking an eye, they said $500 a barrel. And when we said, wow, they said in the 1970s, those two oil price shocks, the first one quadrupled the oil price, the second one tripled the oil price. It went up 12 times in 10 years. So saying the oil price will go up 5 times in a full recovery scenario is not out of sight. Now at $500 a barrel, all your lives will change. You won't drive to distant shopping malls, you'll shop at the local 7-Eleven. All of you in this room will install your own solar panels and power your house with your own unit. You'll become miniature Escoms. There's lots of things that will happen. So there are vast opportunities and huge threats in this scenario which you have to examine, and particularly which companies are going to win and which companies are going to lose. We give this scenario only a 10% probability at the moment because our principal flag is firstly a decline in American unemployment to between 7 and 7.5% to show that America's in a recovery, and secondly that they actually do something about their budget deficit. And yes, on the first count, the unemployment rate has come down to 7.8%, so we're watching to see if it comes down further, and then we'll increase the probability of that scenario. But on the second flag, the fiscal cliff, as they call it in America, is still there. The last scenario is the one that we all dread, a double dip. The worst is yet to come. We call that scenario forked lightning. You go down, you have a recovery, and then you seriously crash. And there is a parallel, 1932. Because everybody talks of the Wall Street crash in 29, it didn't. It went down in 29, it recovered in 30 and 31, and then it really crashed in 32. It went down to 11% of its peak value in 1929. So the equivalent today would be the Dow Jones, which closed last night at 13,300, falling to 1,500. And Americans losing between 80 to 90% of the money they've invested in equities. It's a nasty scenario, forked lightning. And yeah, we asked American fund managers, is this a viable scenario? They said yes. So then we said, what are the flags? And they had 2 flags for this scenario. The first is that American 10-year US Treasury interest rates suddenly jumped to 4 to 5%, so that rather like in Spain and Italy, people have lost confidence in the country and particularly its financial management. That hasn't happened because interest rates are 1.6%, but guess what? The American Fed is buying 40% of the bonds that are issued, so the rate is actually artificially low. They average out at 11%, now they're up to 40%, but we feel that flag is down. But the second flag is the one that's rising. These guys said a default by either Italy or Spain. They said Greece doesn't count. Greece is small. It's already had its bonds devalued by the people who hold them. But if Spain or Italy goes bankrupt, or the banks have to take haircuts, I love that word, haircut, on those bonds, then you could see widespread bankruptcies in Europe, and in fact the financial markets would freeze yet again. And we all know people are worried about Italy and Spain with the unrest that the austerity measures have created, whether they'll be able to cover themselves. The European Central Bank has said that it will buy Spanish and Italian bonds, but have they got enough money to do that? So at the moment, we give that scenario a 20% probability. So that's how we kind of look at the future. We look at it like foxes. There's a book behind you which is called the Fox Trilogy, which has our entire methodology in it. But we just feel, in this day and age of volatility, uncertainty, shock events, that you have to look at the future like a fox, where you're constantly surveying the environment. You're looking at how the flags change. And then it's the speed and quality of your response to those changes which allows you to defend your wealth as an individual or defend your wealth as a business. And so now I'll hand you over to Cobie, who's going to tell you exactly how to do that.
Thank you, Clem. A couple of months ago, I said to Clem, wouldn't it be great if we could build some investment cases for your specific scenarios? And he said to me, by all means, let's give it a bash. You know, let's have a look at what these potentially could look like. And I'd like to firstly start off by just showing you visually what these various scenarios look like. You see that on the x-axis you've got low economic growth and high economic growth, globalization at the top, and then fragmentation at the bottom, or divided world at the bottom. And then you can see the various scenarios that Clem was speaking about. You've got hard times on the far left-hand side. You've got the new bulls please scenario on the far right-hand side at the top end. The fork lightning type situation, that's a perfect storm that Clem was speaking about a little bit earlier on. And then you've got the UV world, which is that divided world that you see at the bottom end. That's just a graphical representation of the 4 different scenarios that potentially could be playing itself out. Now I'd like to potentially say to you that what we're going to be doing today is we're going to be looking at various investment cases for the various scenarios. This is not financial advice. In order for me to give you financial advice, I need to be able to understand your specific investment objectives, and obviously I don't know what those are. So this is merely just a response to these various scenarios. And I'd like to start off by showing you how a traditional approach to asset management looks like. And this is what is called a risk-adjusted age profiling system. And this is literally what asset managers do. They would say that if you're below the age of 40, well, you need to own a lot of shares. And then, well, as you get older, you need to own less and less and less shares. You know, and well, if you're over the age of 70, you don't need all the growth that you need to get. So, quite frankly, don't own a lot of shares. The problem with these, though, and the system that you look like, something like this, is that if you end up living till you're 100, you've got a problem. Well, because you just don't have enough money, because you just don't own enough shares. The other issue is that we haven't taken any of your investment objectives into consideration. That's the one problem. The other problem that you've got is that what would this look like if you were a fox? And if you had fox-like attitude to investing. So what we're going to be doing is, I'm going to be filling in the be a fox category today by looking at the various scenarios and how you might be applying asset allocation to the various scenarios. So let's start off with a hard time scenario. That's a 40% probability. It's what Clem calls a flat world. It's where there's no GDP growth. Literally, countries literally just kind of stagger ahead 1 year in front, 1 foot in front of the next one, year after year. And the example that Clem used was Japan, and I'd like to show you what Japan actually looks like so you can just understand this. This over here is called the population pyramid. Now it doesn't look like a population pyramid, it looks more like a funnel, but you'll see, we'll show you some other ones a little bit later on which actually looks like a pyramid. On the far left hand side you've got males, you've got females on the right hand side, and then you see all the ages all the way up as they go. And you can see that right at the bottom end, right now for Japan, you've actually got very few people entering the system at the bottom end of the age profile. People that are in working age is actually okay, and then you've got people at the top end, kind of people that are retired. And those folk obviously are being supported by folk that are actually working and driving the economy. That's okay as far as the demographic profile is concerned, but look what happens by the time you get to 2020. Not so good. And as a matter of fact, by the time 2050 is going to come around, the majority of people, the minority of people that you've got at the bottom end of the scale is actually going to be problematic for this economy. You see, anything in an economy starts with demographics. You have to understand what demographics look like before you can start looking at what markets look like. So this is one of Japan's big nemesis, or one of their big issues that they need to be taking into consideration. And obviously, the driving factor here is obviously the markets. This over here is a Japanese market. In 1988, it hit its peak of, there you can see it, the Japanese topics at just about 3,000. And since then, you've seen the slow ride all the way down. It's a long, long drive, over 2 decades worth of absolutely no returns. As a matter of fact, if you missed the top end of the market and you invested at the bottom end, you still would have gone absolutely nowhere. And as a matter of fact, if I showed it to you from a price to earnings ratio perspective, you could see what this market looked like. In 1988, this economy, or shall I say the market, was trading at 50 times earnings. Now, just before we carry on, not everybody might know what a price to earnings ratio is, and I'm going to be talking a lot about these as I continue. Price to earnings ratios is literally the price you pay for the earnings that you get in the market. So, if you're paying 50 times earnings for a business, you in essence have to wait 50 years in the price that you paid for the business for the amount of earnings that it needs to make up. That's a long time. As a matter of fact, the price to earnings ratio of the market, it was at 55 times earnings, is at 10 times earnings today. Japanese economy is a fairly insular economy. It's a people group that kind of is very defensive as far as their culture is concerned. In order to make sure this thing grows long term, they might have to start opening up this economy. They might have to start thinking outside of the box and stop being as insular. Part and parcel of the environment that grew price to earnings ratios to this level was firstly cheap money that led to a property boom, and the property boom was never allowed to deflate itself. And hence, the situation that you're seeing at the moment. It's interesting that we continue to look at 1988, because 1988 was a point where it was the last time around that the Japanese economy actually grew. Anything beyond that was just kind of very sporadic growth. Very, very difficult to grow any business, especially when you're selling back into the Japanese economy. So if you can't buy the market, and you can't focus on buying the market as a whole, how are you going to be buying stocks? Well, one of the ways is, and as you can see the caption line there, cash is king, is to potentially understand from an oscillator perspective when the market is buying and when the market is selling. This over here is a 12-month moving average oscillator for the Nikkei 225, and you can see that it was far stronger if you go back to just before 1988. That's that point where the economy started kind of faltering. And look since then, kind of where it's been trading. Understanding when it's cheap and understanding when the momentum cycles happen might help you understand when to own stocks and when not to own stocks. And then obviously understanding what you're buying is classically important as well. Here are the largest companies listed, or the top 10 largest companies listed on the Japanese market, the Nikkei. And you can have a look at the sizes of the businesses over there. Those are their dividend yields. And there's the price to earnings ratios. And we carry on talking about price to earnings ratios. And I'm going to show you a little bit more about price to earnings ratios. Just before we do that, look at the bottom business there. Nissan Motor Corporation. Carlos Ghosn is the guy who runs this business. And over a decade, he's taken this business from being fairly insular to something that's a lot more kind of accepting of the world. Nissan, as you know, sells most of their product globally today. Have a fox-like attitude as far as Nissan is concerned might potentially help you. Let me show you why price to earnings ratios are so important. Because I carry on talking about price to earnings ratios, and we're going to be talking a lot more about those. I'd like to show you the South African market. These are different price to earnings ratios for the South African market. And these are the 5-year average real returns you could be making by owning stocks. Now, the average 5-year real return is literally the market return minus inflation. So it's in real terms. It's actually what you put back in your pocket. And it's interesting. When markets are cheap, hence, you can have a look over here, hence you're not paying up. Price to earnings ratios are very low. The average long-term returns, or the average returns that you're making out of stocks are actually quite high. But as the price to earnings ratios continue to rise and rise and rise and rise, guess what happens to the average returns? They just carry on dropping and dropping and dropping. And hence, you can see that the title of the slide says, are you a dog whisperer? Well, in the industry, we call a business that have lost a huge amount of value, we call that a dog. And maybe it's worthwhile for you to be a dog whisperer. And we're going to be talking about being a dog whisperer later on as well. Because being a dog whisperer means you understand how to buy cheap businesses and getting long-term returns. The other interesting thing to take into consideration, remember, is that dog whisperers can be bitten. And that's why diversification is so important. Because you might be buying a business that is cheap for a reason. You might not be buying a business because it's just merely mispriced. That's why diversification is so important. So, if you were living in a hard times world, a flat world, from an asset allocation perspective, you would certainly be owning equities in South Africa. You'd be owning global equities. but you would also be owning a lot of cash and a lot of bonds, or some bonds, shall I rather say, in South Africa. And this over here is really the dry powder that you'd be utilizing in order to buy South African equities and global equities. And there you have to put a methodology in place in order to ensure that you understand what you want to buy, how you want to buy it, and in essence, when to sell it. And being a dog whisperer will certainly help you as far as this is concerned. The other big scenario is the ultraviolet scenario. That's a 30% probability to that. Now, really what we're talking about is a U-shaped recovery in the old world, or what we call G7, and in emerging world is what we call a V-shaped recovery. It's kind of a catapult of the V. And the real question is, where will China be? And before we're going to answer that question, let me show you some demographics for the United States. Clearly, the United States likes to have children. If you live in America, kids are big. And that's a good thing. Because if you combine kids are big with skill, well, you can run an economy. Because demographically, you're not deficient. So maybe understanding a UV world has got a lot to do with understanding the demographics that you're going to be in. Look what the United States looks like by the time 2020 comes around. It still looks pretty good. Very few people in retirement, and supported by a massive amount of people actually coming through the system, driving the economies forward all the time. Let me show you another G7 country. And as a matter of fact, Clem showed you and spoke about Spain just now. That's not a demographic pyramid, that's a demographic funnel that you're seeing over there. You can see it's predominantly deficient, demographically deficient. You've got so few people at the bottom end coming through the system because it's not cool to have kids in Europe because it's too expensive. And you've just got more and more people kind of funneling towards the top end of the spectrum. Spain is a country in trouble. 2,500 protests this year alone. Heck, they're going to need austerity, or I'd rather say they're going to need a bailout just to carry on protesting. We think marijuana was bad in this country, and what we're seeing as far as the strike action is concerned, and it's terrible what has happened in marijuana, but certainly we haven't seen any of the protest actions that have happened in Spain this year alone. So the first thing is, if to understand a UV world, you have to understand the demographic profile of G7. Where is it that these economies are going to be? The other thing is sentiment. And sentiment is what drives market short-term. Over here, McKinsey asks of their global clients, this is, by the way, a consulting business here, they say to them, how do you feel about the world? Where do you think the world might be? And they ask the question, what is the biggest potential risk to economic growth in the next 12 months? In the respondents' countries, most people believe it's low consumer demand, one or more sovereign debt defaults, potentially followed by increased economic volatility. In the global economy, well, large one is sovereign debt defaults, another large one is economic volatility, and then the other one is a geopolitical instability. I mean, a lot of this stuff we know already. As a matter of fact, you read the news, you can see a lot of this stuff. So it's already known. The interesting thing is, right at the bottom end, most people don't believe new asset bubbles is a problem. And I'm going to show you one of the largest asset bubbles that are building as we speak at the moment, and it's all predominantly because of fear that is driving the system. So, in a UV world, what is a fair price to pay? I mean, you could get American market, that's the S&P 500, or for 17 times earnings, price to earnings ratio. Let's pick another one. There's the IBEX 35 in Spain, it's 7 times earnings. Are you a dog whisperer in Spain? Well, it depends what kind of business you're buying. They might be cheap for a reason. There's a Hang Seng in Hong Kong at 9 times earnings. That's the gateway to China, really speaking. That's where full liquidity lies. And there's the FTSE Aussie. That's the building you're sitting in at the moment, trading at 17 times earnings. Aggregate all the businesses that are running on the ticker box behind you there, and you get to 17 times earnings. So what's a fair price to pay? Well, I'd probably say that it continues to be important being a dog whisperer, regardless of the scenario that you're in. And let me show you why. You're seeing the price to earnings ratio for 2 big markets over here. The one is the JSE Aussie, and that's in orange, and the other one is the red line, which indicates the 500 largest businesses in America, or the S&P 500. And you can see that at some point, the market will forget to be a dog whisperer. At some point, the market will run away with itself. Euphoria will come into the market as people continue to be so irrational about the future prospects of the businesses that I bought. And I'd like to show you that situation in 1995. In 1995, the market was trading at 15 times earnings. Nearly a decade later, the American market was trading at over 50 times earnings. Very difficult being a dog whisperer. And this is where your attitude towards markets become really important. Somebody said to me once, the game is easy, but the rules are easy, but the game is difficult. And I'd like to say that to you. If you're going to be investing money, that's certainly something to take into consideration. As the market hit 50 times earnings, you can see how the market starts collapsing all the way back to its long-term average of about 12 times earnings. And that ushered in the subprime crisis that you've just lived through in America. And as earnings collapse completely, you see the price to earnings ratio for the market going all the way up to about 140 times price to earnings ratio for the American market before it collapsed completely down as the price literally just imploded all the way down. Today, total price to earnings ratio for that market is sitting at about 17 times. Now you can see that in the South African market, you never get that. Why? Well, because from a price to earnings perspective, we're what we call a mean reverting economy. I always call that the gift of the Washington consensus, and if I have to start talking about that, I'm going to be here for about 6 hours. That's maybe a presentation for a different day. And when I say mean reverting, look what happens to price to earnings ratios. As they go up, they come down. They go up, they come down. And that's how they trade. They always trade in a band. And this is very important to understand in the UV world. Continue to be a dog whisperer, regardless of what the market is telling you that you should be believing. So, what does the American landscape look like at the moment? Well, there you can see the largest businesses in America. Apple at the moment is sitting at about $623 billion US as a business. The largest corporate in America is about $72 billion. It's a big business. As a matter of fact, Apple introduced us to products that we didn't even know we needed a decade ago. And there you can see some of the price to earnings ratios for some of those products, or sorry, for some of the companies, the dividend yields and the market caps. General Electric is potentially worthwhile to point out as well. I mean, here's a truly global business. They've got a business, as a business, they created a product called the V-Scan machine, which is a portable scanning device for medical purposes. This was developed in China, sold in India, and today it's a product that is sold right across the globe. So maybe the way in which you actually get the UV bet right is by actually betting on those businesses which could potentially aid or potentially have a V-shaped kind of benefit, but they're still in a U-shaped type country. Hence the benefit of the U, making money out of the curve of the U, but you get the catapult of the V right as well. Maybe the right place to be looking at those is potentially the United States of America. Certainly, many of these businesses have got the money and the know-how in order to actually do business in the emerging world. A lot of people would say to me, well, I don't know how to buy the companies, I'd rather buy the index. I'd like to go buy an exchange-traded fund. It certainly is something that you could be doing. Just remember one thing, not all exchange-traded funds are created equal. And here I'd like to show you the S&P 500. If you bought an ETF that tracked the S&P 500, the majority of the earnings are represented by the United States and other developed markets. You're not really getting V-shaped type opportunities to buy the whole market. It might be worthwhile for you to start looking at single-based businesses. So, in the UV world, if you were the UV fox, how would you be investing money? Well, again, South African shares would kind of feature. That would be important because you're in this country. Global shares would feature as well. But you would now have a block that you could potentially put into global property. And that's quite simply the reason is because you're going to have a U and a V-shaped recovery. So if you're in global property, this becomes kind of, there's going to be expansion. So that kind of plays into that space. The important part is that you continue to have a fairly large yield-based block that you could be utilizing to buy equities or potentially global property, especially when there's volatility. Remember, UV world will continue to have volatility. Again, being a dog whisperer continues to be as important as it was in the hard times scenario. The New Bulls Please scenario only has about a 10% probability, but this is a big game changer. This is where the US recovers, as Clem's quite rightly said, it's where Ben Bernanke is right and all of us are wrong. And this is the big catalyst here, obviously, that has to affect is East meeting West, the game changer, so to speak. And then, obviously, resource prices soaring. So let's start off by looking at China from a demographic perspective. You can have a look at what that looks like at the moment. You can see the one-child policy at the bottom end of the scale. You can see how well that's working for them. And I'd probably like to suggest that the insular society that China is at the moment potentially has to become a lot more accepting of the world in order to kind of drive this into an area which could potentially help them into the future. 2020, you can still see a fairly large workforce, and as a matter of fact, if I carry on looking what the demographic profile looks like for China by the time 2050 comes around, where you're quite frankly sitting in a situation which is a lot different to what it will look like in 2020, and potentially an economy that potentially could be in trouble. The beauty of these economies at the moment is that the economic firepower that you're picking up here is huge. During the Industrial Revolution, both America and Britain went into it with about 10 million people each. Both India and China have over 1 billion people each. You can just kind of think about the economic leverage that you're picking up if something like this potentially had to happen. And Clem actually pointed some of those out with these 4-planet scenarios that he kind of thought about. One of the saving graces for China, could potentially be a saving grace for China, is that it's centrally planned. There's one party that decides what happens with this economy. It's not a democracy at all. And over here, the Economist has done some work where they looked at GDP growth over time for China, and they looked at components that drive this GDP growth. And they said, well, it's actually consumption-led, and it's also investment-led. Reserve battery level, so whoever needs to know about that. And you can see that from an investment perspective, there's actually a central party that decides to turn on the taps as far as investment and actual spending, what we call fiscal spending, is concerned. And at some point, if GDP growth continues to falter and falter, this is something that they would certainly have to start thinking about quite drastically. The other thing which needs to be taken into consideration is if China grows, well, there's going to be an export boom elsewhere. This is America. And it shows you the GDP growth for America, and it shows you through different time periods. You see at the bottom end of the screen. And it shows you how much is made up out of consumption and housing, and hence the problem that they've got at the moment, the fact that it's been so big as far as housing is concerned. And you can see that from an export perspective, you can see how exports have started actually rising. Mitt Romney will make you believe that actually America has been badly managed by a man like Obama. And actually it hasn't, because look at what he's done for exports. And as a matter of fact, America would have to start showing a lot more from an export perspective. McKinsey's did a global survey again, where they looked at 1925, they looked at the product leaders in 1925 in 17 different product categories. If you were number one in your product category in 1925, you exited the century as either number one or number two. A head start is classically very, very important when it comes to these things. To show you the head start, The Economist has done some work in what they call the Sino Dependency Index. Now let me quickly tell you what that is. They compare the Sino Dependency Index over here relative to the S&P 500, which is just a normal index in America, the 500 largest companies in America. And the Sino Dependency Index are those businesses that kind of export the most to China. They're US-based, but they're exporting to China. So it's market cap weighted like a normal index, but multiply that out by how much earnings you actually get out of China, and you get the Sino Dependency Index. Now the first thing to notice is that the Sino Dependency Index actually did much better than what the S&P 500 did over time. Who are these people? I think there's a saying that says, who are those people? Maybe the people that live next door. No, it's not. It's actually, here are some of those folk. You can see some of the large corporations in America that are there. The largest weighter in that is Intel at 8% weighting. Look at the position shift that Apple had during that period. 2% of the index in 2010, over 6% of the index today. That is, as more and more people are buying the iPhone, the iPad, and any of the Apple products. And you can see some of the other businesses there. IBM, General Electric, Caterpillar, Procter & Gamble, Johnson & Johnson, all the way through to Boeing on the other side. So, they're certainly doing something wrong, something right as far as the export capability is concerned. What do they look like from a price to earnings perspective? Well, there you go. There's the price to earnings ratios for some of these businesses with the dividend yields. And you can look at the size of the organizations. Potentially worthwhile to point out a business like, such as Yum Brands. You might not know Yum Brands. Yum Brands, if you don't know Yum Brands, you know KFC. This is the owners of KFC. If you've shopped there in the last week, you've made some money for Yum Brands. They've, in essence, sat with the India chief and said to the India chief, listen here, it's very important for you to kind of report directly to the global CEO. Why? Because this is such an important region for us. And they're going to start doing that potentially with their Chinese business as well. This becomes important. The question, though, that I have for you is, can you be a dog whisperer as far as these businesses are concerned? And do you understand to be a dog whisperer? Because certainly that helps you as far as long-term returns are concerned. So what does the Ballsy Fox look like? Well, the Ballsy Fox firstly owns South African equities and certainly resources in the South African scenario. It owns global equities and then continues to own cash and some bonds in the South African scenario. Maybe even some corporate bonds in the South African scenario. You don't have a major default that happens over here, so you don't have to worry too much about the bond exposure. But this over here is a block that you could be utilizing to be spending into an equity environment that changes on a continuous basis, which obviously is of critical importance. You might be a dog whisperer here, but just remember you might actually be buying a greyhound long term, which is certainly a situation you want to be in as an investor. Fork Lightning, this is a 20% scenario. This is the one that should put like that shiver down your spine. It's the double dip. It's where 10-year bonds spike and you literally have a default as far as Italy and Spain is concerned. So, let me show you what this will look like. And Clem spoke a little bit earlier about 1929, and I'd like to actually show you what that actually looked like. You can see X marks the spots. There you can see 1929 happening, and as a matter of fact, to see it more properly, I'd like to just hone in on that. There you can see it. Market runs up all the way up to 1929. There's the first crash that happens. And only in 1931 does the proper crash happen. As a matter of fact, to get back to the last high point of the market, which is that point, you have to wait until 1953. As a matter of fact, you have to wait a whole world war out. You have to wait out Bretton Woods, and you have to wait for the gold standard to come back into play before this market actually gets back to its previous high point, which certainly is a huge amount of time that you have to wait. And this is what people are talking about. They're talking about 10-year bond yields spiking. In 1979, you could have bought Japanese, British, or American bonds at a yield of about 10%. All those yields today are sitting right at the bottom end of the spectrum at about 1%. And you can see the massive yield shift that has happened over 2 decades. As this happens, you continue to see prices just escalating and escalating and escalating as far as bonds are concerned. This is probably one of the biggest bubbles that have been forming as far as debt instruments are concerned. The other line over there, obviously, is South African bonds. So you can see South African bonds where they're trading relative to those. Remember that if you have a default globally, you're sitting in a situation where as bonds default and they continue to shift higher, they're going to shift yields in South Africa higher as well. I've got that. Thank you, ma'am. As these continue to shift higher, this potentially could have a default into situation, into course. As a matter of fact, if you want to see how low dividend yields are, or so I'd rather say how low bond yields really are, you can just have a look at this chart over here. This shows you the number of companies on the S&P 500 with dividend yields that are in excess of 10-year bond yields, 57%, which is actually very, very, very high. As a matter of fact, I don't think it's ever been this high. And then this is a story that most people will tell. It's a story of Europe. It's a story of literally a overfunded or underfunded situation as far as Europe is concerned. This over here shows you various countries, and it shows you the foreign banks' exposure to Greece, Ireland, and Portugal at the top end of the lines. So in this case over here, this is Germany's foreign bank exposure to Greece, Ireland, and Portugal at over 225 billion euros. What have they actually put into the IMF, and what are they actually doing as far as funding is concerned? Well, that's the maroon bars. You can see that's only about 50 billion. You can see how disparate the liabilities are relative to the assets. And this is one reason why you can continue to see why Merkel and Sarkozy, or used to be Sarkozy, are literally sitting on a continuous basis trying to actually find out how they need to actually deal with some of this stuff. So, if a lightning situation happened and you were a fox, what is it that you would be doing? Well, you'd own a huge amount of cash, as you can see over there, with some equities at the bottom, local equities, and then also some global equities. And you would literally be sitting and waiting for a situation where you could be deploying this cash. And then you would have to be very careful on how you deploy this cash so that you could be taking some money off the table and then putting it back in should that be necessary. So, what do the different foxes look like together? There you can see them. It's ironic that between the hard times fox, UV fox, and the ballsy fox, actually the scenarios actually look quite similar. As a matter of fact, I mean, you've got some global property inclusion on the one side, but it certainly isn't, and that really is just the inclusion for the UV fox. That changes. But if you have a look at the other asset allocations, as a matter of fact, those look actually quite similar. The only one that is hugely different is that of the lightning fox. And the reason why we own some equities in the Lightning Fox and the global equities on the other side is because we actually don't know when this is going to happen. If you know when this is going to happen, please let us know. Let me put the two probability curves together. Hard times in UV has the majority of the probability. And you can see that we've kind of circled those relative to the Ballsy Fox and the Lightning Fox with the lesser of the probabilities. Go and take these and apply these to your own specific circumstances. You have very specific circumstances led to by your own personal situations. Apply some of these because you'd be applying the scenarios, and watch the scenarios and as they change. And remember to be a fox. More importantly, also, shall I rather say, be importantly, remember to be a dog whisperer with that. And I'm going to leave you with trying to understand what a fox-like dog whisperer looks like. If you want to visit us, please, those are our websites. Thank you very much.
Yeah, just we're conscious of time, but if there's some questions, yeah. Okay, what about South Africa? Right, we are offering 3 scenarios on South Africa at the moment. The first we call Premier League, where South Africa remains in the top 59 nations. We were listed in May as number 50 out of 59. We should be 32 because we are the 32nd largest economy in the world. But we're listed at number 50 because of policy uncertainty deterring foreigners from investing in South Africa. And I'm afraid to say Marikana has not helped that at all. The second scenario we call second division. It's where we actually don't get our act together. We fall peacefully into a scenario where we become a peaceful and poor third world country. And yes, you can still make money in the second division, but it's not a great place to be for government because they won't get the tax revenue that they got in the Premier League. The last scenario is where we have a flag of violence and we enter a failed state where we basically just lose completely all respect in the world, just like Syria at the moment, just like Afghanistan, just like Somalia. People don't invest in countries which are violent. At the moment we're giving a 25% probability to failed state, which is very high, and the reason is simple, that Marikana has changed everything in South Africa. We're now in a society where workers won't listen to unions, they don't listen to employers, they don't listen to the government. They do their own thing. And secondly, we have a lot of very angry young people in South Africa who are not employed. And so if the angry workers get together with the angry unemployed, you have a failed state. It's as simple as that. And hang on. No, well I won't, let me finish. The second scenario is as I said, the peaceful second division country. We give that 25%, so we're 25-25, which means we're still giving 50% to staying in the Premier League. And there are 3 flags we tell people to watch about that. Inclusive leadership. The last thing we need right now is to become a racially divided society again, because we will definitely quit the Premier League. We need an inclusive leader like Nelson Mandela was. Number 2, pockets of excellence. This country has incredible pockets of excellence in virtually any activity. We have to replicate those pockets of excellence. And number 3, we really do have to do something about small business and entrepreneurship in this country, because if you look at what drove China to number 2 in the world, it's the entrepreneurial revolution that has taken place there since 1978. And the reason America has been the number 1 economy for so long is because they worship their entrepreneurs. So we have got to change the whole climate for small business in this country and make it much more favorable. Trevor Manuel, in the National Planning Commission report, said that 90% of the jobs to be created by 2030 to bring our unemployment rate down to 6% in South Africa will have to be in small business. So I feel like saying to him, duh, why haven't you made the entrepreneur the centerpiece of the National Planning Commission report? So don't, take tonight's plane to London. There is still plenty of hope for this country. but we have to keep the red flags down, and that's why I've been calling for an economic CODESA. And maybe the summit that the President has just had with business and unions, maybe that will turn into a long-term economic CODESA where we can actually create a new entrepreneurial and inclusive economy.
Nice. Jess, we're going to be at the table outside, so if you've got any more questions, please ask us there. Thank you.
Yes, Jeff.